Hello everyone, thank you for your participation. With so many acronyms, how can we differentiate things? What is the difference of each type of investment? How do we define the strategy which best works with my agenda, with what I believe in? These are very common questions among those who start to learn more about this segment. And to help us understand these different strategies, I have the pleasure of calling Alexei Bonamin, partner of Tosini Freida Law Firm, which will lead this conversation. Alexei, thank you. Thank you, Chris. Good afternoon, everyone. I'm very happy to moderate this panel, which talks about, let's say, philosophy, and I wanted to talk about this differentiation between ESG and impact. Let's discuss this. All of you are experts, and we are very happy to have brilliant panelists here who will enrich the conversation. Today, we have Bruna Ariotto, Managing Director of Stepstone, Sebastian, who's the founder of Aqua Capital, Carlos Miranda, CEO of X8 Investments, and Gustavo Pimentel, Director of Citaui. Well, I've already spoken offline with all of them, and there are very nice things that we're going to share with you today. Our ideas that you in the audience feel free to ask questions so that we may interact with you. I would start asking Bruna, speaking about ESG and impact, how do you see the main issue, that is ESG and impact? How do you see these issues in your day-to-day? Thank you, Alexei. Thank you, everyone. Thank you, all panelists. It's a pleasure to be telling you about how we see this topic inside Stepstone. First, I'd like to present myself. I'm Bruna Ariotto, Managing Director of Stepstone in Brazil. I joined the house since 2014 when they opened up an office here. Stepstone is a global company focused and specialized on alternative investments throughout the world. Nowadays, we represent over 330 billion under management, representing investors from different profiles, from family offices to insurers, pension funds, sovereign funds. What I can say is that this kind of client profile that we have been feeling more worry on their part in terms of ESG and impact investing. We'll tell you how each one interprets the difference between the acronyms, but inside Stepstone, I could see clearly the development and the attention that this topic has been gaining here. Nowadays, there is a sector team focused on impact sectors, covering the impact. We have an investment committee which analyzes all of the environmental, social, governance aspects for all the investments that we make throughout the world, not only in PE, infrastructure, real estate, and private credit, and it works as a subcommittee to our global investment committee. Every investment approved internally goes through a committee, a ESG subcommittee. They analyze all those aspects in each one of the investments, not only to make investment decisions, but how these aspects will be considered in the post-investment and how that manager manages that. And we look at many more details than 6 years ago. And this is due to the demand and the attention that our clients have been giving this. I've seen deals not work out because of ESG items, either the client's expectations are too high or not, but nowadays that's how it is. It is one of many different performance criteria. ESG is just one more acronym that we give the same importance to within our due diligence process. Your view is very nice, actually, knowing that it's working out, knowing that the methodologies are working out, and that's great. Afterwards, we'll go into more detail. I would pass the word now to Sebastian so that he can provide us his feedback. Thank you, Alexei. It's a pleasure to be here. And the preparation, coordination of the panel was very nice. I was chatting with my colleagues. Aqua Capital is a private equity firm. We invest in consolidated companies and growth companies inside the agribusiness sector. We have seen higher ESG deals than in the past. And this has to do with a culture where ESG basically was embedded into our DNA. The fact that we focus on the agro sector, this ESG agenda is a bit more prevalent, and we've really been trying to understand what ESG means, and we've been really trying to put it forward as a best practice and to enable it as a best practice. And ESG has a lot to do with compliance, since you have to enable controls, guarantees, and it's much more of a risk management. You basically just have to prevent downsides. You have the deal prospecting activities, you have remediation plans, and then you have the day after. And perhaps the most interesting point here is that regardless of you being an impact fund or not, what I think changes things, and it changes a lot beginning last year, what changes is that we see that the intention of people, way beyond compliance has been very positive. People have been going beyond compliance, beyond the ESG. People have been focusing on all the ESG concepts. One of our companies was the first Brazilian company to be certified on the Women on Board certification, and all of our companies have women on their boards. It's just one of 20 initiatives that we have had. And today we see that the focusing on impact doesn't generate loss. It's actually a nice win-win. Our biggest drive, our biggest message, the companies that we prospect plus our portfolio, where we have 32 companies and 10 platforms which have 10 billion reals in revenue. There's lots of impact there, and we want to take this forward how? With all the responsibility due, but knowing that in most cases there is no trade-off between doing good, at least gradually. There's no trading off. There's no difference between trade-off and a financial return. Well, besides investing in companies that have positive ESG numbers, inducing companies to adopt ESG is also an impact as well. We'll go back to that right afterwards. But now I would like to get the first impressions of Carlos, from Carlos. Thank you. Thank you for the invitation. How did we end up building our investment thesis throughout these 12 years? X8 Investments we started 12 years ago. We were called BR Opportunities at the time, and at that time our objective was to invest in mid-market companies, exceptional entrepreneurs, rapid growth companies. And we knew we would have to invest in companies which would generate an impact. At that time, perhaps we would set the ESG agenda as one of the things in the decision tree that the company would have to have. And we understand ESG today. Throughout these 12 years, we had been involving it, and we had been defining that our thesis should be built with impact being the last criteria in our investment decision. If we look at X8, 12 years ago, it would be what Sebastian said. We had ESG just as a list of compliance items, a list of things that we would have to do. And the understanding is that the business we would invest in, besides anything else, they would also need to have an impact investment. We don't do that nowadays, you know. We are the intermediary of the impact, but the impact has to be 100% in our DNA. We have to understand the impact. So we know that I have to have all the criteria and I have to have good filters criteria to find a good company to invest in with good thesis, rapid growth, mid-market, bringing quick financial returns to our investors. But my last criteria to see that whether it makes the short list or not is that we want a company that generates impact, and if I remove the impact that it generates, it stops existing as a business. The impact is 100% intrinsic to the business, and then we bring this difference. And we focus on impact versus ESG. ESG is something of the future. Daniel talked about this, and ESG will be basically the new norm. Just like ethics, just like transparency, just like governance, it's an obligation that this be part of the investments. And ESG for us is the same thing. And from here forward in our decision, the differentiation is, the differentiation is that if you remove that, the company would not exist any longer if you did that. We're going to go back to that as well because many people, the previous panel said, well, is it a fad? Is it not? But it's hard for us to imagine a world where this is not the new norm in a few years. And the question will be why a company doesn't have, doesn't do anything for social, doesn't do anything for environmental. That'll be the question. But in the meantime, we would also like to get the first impressions from Gustavo. Thank you, Alexei, and thank you, participants at ABVCAP. I'm Gustavo Pimentel at Setawi Company. I lead our advisory team in sustainable finance, ESG, and impact topics. In the last 10 years, we worked with at least 20 LPs and GPs involved in alternative strategies, first with ESG and then with impact investing. Something that we always have to do in our advisory is understand the motivation, the drivers, the LP drivers, and we have to understand how the investment thesis works in the target markets. There's a series of things we try to understand. One of the things is to try to work the definition. I like to use the following definition. ESG is what you do during the day, so that at night you can put your head on the pillow and be able to sleep. Impact is what makes you wake up motivated the next day to work, to go back to work. Of course, in a few cases, we talk with our clients and they say, look, no, I can wake up motivated with other things. I'm not going to need impact to wake up motivated. So let's keep this in the agenda. Let's keep to the ESG agenda and everything will work out. Well, the first thing is to understand the difference. The intentionality is, I agree with what Sebastian said. Intentionality could be at the beginning or in the middle or at the end of the process. So the intention of the impact is something that can help fine-tune the investment thesis. But it could be, you could be in the middle of the process and you could create your deal flow, or you could do the due diligence in an adequate manner, putting in the objective of the impact in the due diligence. And you have to basically, something we have defended here. We are alternative investors with long-term thesis for private equity, venture capital, and there's lots of influence on the path of the invested assets. So you do have the opportunity of implementing the agenda. In ESG world, we call it engagement, your shareholder advocacy. In the private market, that is intrinsic to the business. It's intrinsic to the business. So you can put ESG and impact initiatives to work throughout the investment. Once you enter a company and you exit a company, you must have moved this company down the line. You must have helped it to make progress up the ESG and impact ruler. You don't have to have a perfect company, at least not in the beginning. And I think that's what I wanted to say, and I'll leave it here for us to continue our talk. I'm going to ask Bruna a question right now. Stepstone is present in many regions. How do you see things happening in other regions in Brazil? The countries are in different stages. Many funds are also in different journeys, and this is a journey, and it's normal that we take this difference in different moments from different players, and we also have to know that we're undergoing a transition into the new normal. How do you see this in the countries where you operate here in Brazil? Can you tell us a bit about that? Yeah, I think there is this differentiation between the regions among a few sectors as well, but I would say an illustration of this is our client appetite for impact investments. We see a few clients starting with a specific allocation of their portfolio into impact investments. They're still very focused on mature markets, US, Europe, but we believe that the trend of that throughout the next few years is to start to focus on emerging markets. That's where the ESG and impact industry is right now. We know that this is a strong topic offshore. We see this topic gaining relevance, especially in the last 5 years, especially in the last 2 to 3 years. This is something that happened that started perhaps 10 years ago abroad, and the industry has developed a bit better, both in how they set up these topics and these analysis, how they expanded this and started to monitor this and divest. In the beginning, everybody mentioned this, and I also saw this in the previous panel. And really, we used to do just a checklist. We used to just, go down the list and do what some of our investors needed. And as the years went by, this started to gain more teeth and started to gain more depth. And nowadays, you have extensive ESG investment policies, how they see this. There are dedicated teams to ESG. There's somebody responsible and accountable for this in the post-investment period. And this has been happening in Brazil as well. We see a number of managers more dedicated to impact, and in terms of ESG, I would say the entire industry is gaining attention, setting up teams, or at least a dedicated professional who's looking at these aspects and who goes after the policies. 5 years ago, in our due diligence, there were many managers who didn't have an ESG policy. They didn't have the whole process mapped out internally. It was a request of our at that time. And, and I would say before we used to see a lot nice to have, and nowadays we see behavior which is a lot different. And these companies have dedicated teams and their processes are much more defined. I think ESG is gaining strength here like it did abroad, and I think that the client's appetite is growing as well. They're still very focused offshore, but they should reach emerging markets as well. And internally, I think the actions were the same. We equipped ourselves, we prepared ourselves to do more detailed analysis and impact analysis. And like I said, we have a department dedicated to manage impact investments, and we have a subcommittee for ESG in all of our investments. I think that this development inside Stepstone, the higher awareness from our clients, says a lot about where ESG and impact investing stands. Your perspective is very interesting. Certainly, I say that this journey, this ESG journey, is everyone's journey. I think everybody is also learning. Of course, they're learning at different stages, but I think that the experience is very important for everyone. Well, Sebastian, before Aqua, he also had been involved with ESG. We didn't even call it ESG then. Sebastian, could you tell us when you were bit by the ESG bug and how that has contributed to you as a manager, to your job as a manager? Well, I told you I had to set up a private equity company because none of them wanted to hire me because I was focused on ESG. I'm an economist. I focused on public policies for a long time, and I ended up in the private sector. Then I set up my own company, and I worked in prior to Aqua Capital. We needed somebody, and I did some training in Holland. This is in 2006, 2007. And then the ESG bug bit me, and I wanted to understand. And I think that the sector view is up to anyone, the huge impact that we can see. And before, we kind of didn't want it. This changes with E, the I in impact. And now we're talking about, let's talk about ESG and let's talk about E. Or let's talk about the I of impact. And when I founded the company, we had this DNA already. And so we had a few foreign companies help us in finding the company or founding the company, having ESG in our mind from the get-go. I think it's also very important for us to not kill innocent deals because, we can make a lot of change. One example. One time we saw a company in Amazon and many people said, look, imagine in the newspaper, milk cows deforesting the Amazon. Of course, we have to study it. Maybe the property has been around, they've been living in that land 40 years. The probability is that somebody won't have their land title but you will be able to get a lot more productivity from a cow that's giving you 8 liters. They'll be able to give you 25 from the same cow with better nutrition, with better management. So ESG has to bring that know-how so that you know where you can go and how to improve and how to act, how to enable that impact. The first variable, which is very fascinating for us, is our amazing capability of revenue or employment generation. We've created 1,800 job positions. One of the most exciting thing in my life was the day when we inaugurated a plant. We expanded a plant. We placed a new building in a plant in the poorest district of São Paulo. And in the board we say, well, the company will grow, the company will export. We need to tell the community that. But that's not only it. This year we announced that we're going to provide a health plan to all the company employees. And this changes people's lives. That is a win-win. The loyalty that we get from our people, the rate of absenteeism or the hour bank is very low. People love to work and they have a very noble mission. I think ESG has evolved from the perspective of, hey, let's just check the perspective and the variables to make sure we're not doing anything wrong. I mean, what businesses can we reconvert? And then you do have the impact piece, which is something else. Where can we intentionally move things, make the world better, and make it so that it's coherent with our financial desires? In the pre-panel we used to play 3 years ago, when somebody said that you were an impact fund, you would clarify, no, I'm not. No, maybe he is. Because there was this trade-off vision, whoever gets impact doesn't maximize the return in the same way. In 2006, Morgan Stanley became our investor. But they said, look, we're not impact, but everything that you do, if you agree to implementing this series of metrics, measurements, and KPIs, we're comfortable. And then when we measure all of that, even prior, without having the intention of being better at ESG, the impact is amazing. In 2020, our minds changed and they evolved. And I would say COVID accelerated digitalization and it also accelerated many other things. And one of the things that accelerated is the impact issue. And personally, I've never seen such a quick revolution in the financial arena. Crypto coins basically brought about a tsunami, and it seems like it was a fad, and it seemed like it was a Me Too movement. And then we saw that people were taking it seriously, and then you can see the extraordinary change in Bitcoin in the last year. The seriousness that it's gaining, the speed with which codes are being created to see what is impact and what is greenwashing or PR. That gives you amazing motivation to continue with this agenda. And I'm going to be very honest. When we start to do our homework, the surprise we get is that many products have better payback than anything else in the company. I have 2 or 3 charts if there is time to share. Very nice, Sebastian. Wonderful, your thoughts. Carlos, talking about the manager, and most of our audience is investors here. Looking at the manager function, you had already mentioned that you talked about the best managers, but you also talked about measurement and monitoring, because more than selecting this best investment for this impact journey, you also have to monitor it so that you can continue to contribute to that journey. I would like you to talk about your perspective on that. Well, first, we felt this in the last 12 years. I remember when we talked about impact, and Bain would ask, well, is it going to bring return? Is it not going to bring a return? And I think that the coolest investments that we had with the biggest investments, we have a fantastic case, which I'll show you in a little bit. This was the investment that they most pushed back on, and it's where we got the biggest return. And when we go to make an investment and when we do fundraising, we were appalled with the speed that we would go into the meeting saying, look, how am I going to explain impact to this guy? And the guy already knew about impact, and he knew it. There was a demand because they started to see that we were getting better returns than the non-impact investments. In terms of monitoring, the first very important thing is that we see a bunch of different ways. We have our measurement criteria, but I think that you have the due diligence, and then the time when you choose your investment. And that's what we said before. If I don't have a business, in our case, in our thesis, and once I remove what we remove it as impact and the business no longer exists, we won't even go forward. And then it's easier to decide. Second, is it still a business that is for us? What do I mean? Is it still focused on the exceptional entrepreneur? If this is not legit, of the entrepreneur. If they are not impact generators, if they're not multipliers, we'll identify these in the small attitudes, in their character and their values, and the way that they interact or the way they get up in the morning to go to work. So when you start to do the due diligence process, the measurement will become a lot easier because it's not a typical traditional ESG measurement. The guy did this, he didn't do that. We use a tool which is AS Plus. We use all the different impact parameters, but deep down at the end of the day, it's what we say. You can use the tool, whatever tool you want, and you will have perhaps lots more work in trying to mitigating the non-compliance to the ESG agenda because you didn't look at it right prior. And so we worry, we measure a lot. But based on our thesis, since I have to bring in business, where impact is intrinsic, when they bring this return, I can scale up this impact and I can scale up this business. And our measurement is much more focused on any eventual deviations you might have. For example, we have our business partner. Well, isn't Uber impact or not impact? And that's a very interesting question. And how do I measure Uber when Uber started to exist? And how do I measure Uber now? What is the worry I have? What eventually could be something that generates impact? And due to its own growth, it pivots to a negative impact. That is a worry. We can say, look, I'm going to generate microcredit to people who don't have access to credit. That's great. But I can create a problem of family debt level generating credit for these families. So that is our worry since we do a very rigorous due diligence once we decide to take a deal or not. That is a great point, and Uber is very interesting actually that you brought that up. And there's many people say that the impact is zero, but that depends on time, and the business models keep changing. Gustavo, at this time of lots of speculation here, could you tell us, since you are an expert, of course, when we talk about ESG and impact, is there one better than the other? I mean, these are different issues and they're complementary because they're not enough alone by themselves. So we need a little bit of each one to be able to really get to achieve a great change in this transition to the new norm. But looking at this paradigm of risk management versus impact, could you tell us more about impact? Could you tell us about measurement? Do we have different levels of impact? It's kind of like those, 50 shades of gray. Can you or can you not have different levels of impact? And I wanted to talk about impact as well. And the impact itself, sometimes it can expand, or perhaps it can take hold. It can generate effects in a way that you can better measure as time goes by. Could you tell us a little bit about that? All right, I'm gonna actually talk about Carlos's examples. Well, ESG and impact are the same sides of the same coin. There are two angles of entry, two ways to assess an asset or a company. ESG is born with risk management, with compliance embedded. And today, we say that ESG is looking at the impact that society and the environment cause on the company. What we call impact is we need to see, when we think about impact, we think, what does the company cause in terms of impact? In case of ESG, you think about how to mitigate the impact from social and environment, and how do I capture the opportunities from that? And the other angle is how do I maximize the positive impact and I mitigate the negative impacts? It so happens that if you look at the topics that we're working on in the ESG universe, sometimes the topic is the same. Therefore, eco efficiency. If I'm more eco efficient in my industrial business, I probably could get a return in terms of lowest cost or lowest expenses with these raw materials, or perhaps I am less exposed to price variations in water, power, I'm less exposed to scarcity of a natural resource. While being eco efficient also helps me reduce my pressure on on raw materials which are collectively used. Basically, it's the same topic with two different angles of view. I like a phrase from Aristotle, and it says, where your talents and passions cross with the needs of the world, that is your calling. And what I like to say to our clients is that where the ESG topic and impact, where the ESG and impact topics cross, that should be the focus of your operation, of your measurement, of your engagement with the venture, with the action plan. Perhaps that would be the first reflection. The second one is that ESG normally is thought about according to the business and the company ethic. In impact, sometimes focuses more on products and services. What is the product and service of that company that company offers the client and the associated impact? But the impact could be in your ethics. In bringing Carlos's case, which talked about Uber, I mean, we can assess, Uber brought mobility. Uber facilitated and it opened up a new labor market for employees with a low training. That's a product and service in a way. But if you think about the ethics and the operations, well, it weakened work relations. It wasn't able to guarantee a fair minimum wage. And these are operations and ethics issues that we have to look at. And something that we should reflect on is that these two concepts are very fluid and dynamic. For a positive impact to provide you with earnings, it needs to be embraced and valued by the stakeholders. At a time when Uber starts to worsen employee relations, labor relations, and once people understand that their business and ethics are not fair, the regulators start to pounce on them and limit their access to markets. Unions start to file civil lawsuit actions, and the courts find in favor of the drivers in a few cases. So when the stakeholders start to receive a negative impact in that manner, they will go after it. And this becomes an ESG issue, basically, because you have to focus on the risk management. And that's why I say that these are fluid. I would like to close my statement agreeing partially with what had been done before, because ESG and impact don't always generate value depending on your time horizon. There could be certain investments which will generate a payback in 2, 3, 5, 6, 7, 8, 9, 10 years. A few ESG ventures only generate this return in the long term. So we have this dilemma of the time horizon, and I think that the asset classes that we're looking at, it's able to basically blow up that dilemma because you're investing long term with your head on your shoulders, so you're much less exposed to a time horizon issue than the fixed income. A long-term investor will do much better than a short-term investor. Certainly, the debate is very high level, and we are raising issues which have been discussed in the ecosystem. When we discuss this, it is very common that we discuss a term which seems like a benefit, but perhaps it's just, well, I'm talking about the genuine character. Since we have many greenwashing and ESG watching issues, so how do we separate one thing from the other and to leave that clear? And that genuinity, I mean, you can have the intention, hey, we're going to do this and we're going to place it as an ESG target. But since then, does ESG impact the targets, the goals? I mean, we're seeing a transition to this new norm, and we have to feed this information daily. We're never going to get to the end of it. We're always going to be looking at ESG issues as we're going to be looking at impact investment. Culture is forever changing and always being fine-tuned. And we always have to retrofeed it, otherwise we lose that culture. And this aspect of the genuine character and looking at how the manager can contribute genuinely to the entire process, I wanted you, Bruna, to talk about your experience. How do you maintain that flame alive, and how do you improve bringing those conversations and improving that journey in-house to contribute to your client's earnings and your client's success? It has to do with what you talked about, what we like to see every time that we do an analysis of a manager. And we always look at that, the genuine worry, the genuine ESG worry. And we don't want them just saying, hey, checking the checklist that we talked about in the beginning. And the best way to assess that and the best way that we can see if there is that genuine worry, that true worry from each one of these companies, we have to investigate examples which worked out, examples which did not work out, and then we have to go into the detail of each one of these companies to see how the manager operated and acted in each one of these companies. I think we do this. I'm going to go back to your question. How do we stimulate that? And how can we ensure that the groups are going down the right path? For our closer relationships, for people who we have investment with, we are always updating these groups and we're always sharing the best practices, and at least that's how Stepstone analyzes ESG. Not only taking part in industry forums and placing our specialized team, our ESG specialized team, at the forefront of the conversation, be it with the investors, be it with the government, but also, raising this awareness in specific groups as well. And the best way is to share how we analyze, what are the best practices. And we do this from time to time, not necessarily when the manager is raising capital or they're looking for a new capital, but from time to time we share with them those documents, those webinars, those contents. And we say, look, we're going down this line, our client base is going down this line, so before we talk about the next fund or next investment opportunity, here's a little bit of what we think about these, how we see these criteria. Let's not have this conversation later on once we have to decide on a new investment. Let's discuss it now so that the manager have time to get ready. You have the internal process. We want to share best practices. We want to share informational content of what we do, what our clients are looking for, way before we get to the moment, way before we make an investment decision. Sometimes it's not, we don't have time. We just saw a situation where we discussed a manager who wasn't actually ready the way that our committee requires. and he was put under probation for 6 months to get ready, to get equipped. And Sebastian said this, the industry needs to be fluid. And Alex, you also said that we are undergoing a transition. We were talking about where we were, where we are today, and where we're going to be. And I think that everyone in the chain has to be very dynamic and flexible, trying to understand the intentions, the objectives of each group, give time, so that everybody can get ready. But once this worry exists, then I think everybody basically is going down the right path. Once we sit down at this slide of the chain, when we look at people who have the opportunity of choosing, who have the chance to choose these opportunities, it's good for us to guide that flow to the deals in funds or deals which have ESG in their roots. If they don't talk about this, or if you approve something which doesn't have ESG in the discussion, we don't see that anymore, which shows the progress we've made. So that's how we disseminate that content, and that's how we ensure that everybody's rowing down the same river, the same direction. And I think that's the best way of guiding the industry in the right direction. Excellent, Bruna. Since we have other great managers, I would like to ask you this question. Many people discuss impact manager versus an impact company. Sometimes you could be there investing in impact company, and you might not be necessarily an impact investor. Is this relevant? Do you need to be looking at impact investing criteria to start investing? How do you see the manager's perspective in impact and their investments in impact? Sometimes the manager doesn't focus impact. Sometimes he might induce impact in his investments. I think that, we always say this. We say that this is a people business. It's not worth you blaming the institution, the committee, the KPIs. Deep down, you have a guy there, and I said this is the first guy that we assess. We can't say that the guy is nature driven and he's not honest and he doesn't keep his word. This is a people business. Therefore, we worry about having the same values at the manager, at the manager's subordinate level. So we qualify ourselves as an investor, an impact investor, which deals with how we hire, how we fire, what's our core business from the time we wake up to the time we sleep. It's no good focusing on impact investing and you cutting a guy off on the road, or you not being able to keep your word. These seem like very simple things, but they are very, very important, and they're very vital, because you're going to need to look at these things when you make a decision. There was an investment we did in Terra, which means Mother Earth. And the investment in Mother Earth company, we found an investor, Luciano Borges, and we always played around, We always focused on impact. He didn't want to deviate the company, and we didn't deviate the company to an agenda which wasn't impact driven. And we had a few important decisions made, first from management, and they, were going to exchange a more expensive product for a cheaper product, and nobody wanted it because that wouldn't be as great in ESG. And so we said, oh, well, could we sacrifice a little bit in profit, but we are building something later on that, could we do that? And then during the time of exit, and then you also talked about this in the other panel, how do I maintain my impact generating mission when I leave? It's very nice. I mean, I already know, thank God. And the thesis is well grounded because I have higher returns. The market pays a premium to buy impact. There is a group of global impact investors who want to buy impact. So I will have good exits. But how do I guarantee that what I am trying to do, that I'm going to be able to get it done? Well, this had been negotiated when we made an exit. Everybody was aligned. The manager was aligned, and the entrepreneur said if we can't continue our ESG activities, then we won't have a good exit. That would be very hard to do. And I mean, that was the best deal in our portfolio by far. Like 12 times valuation, it paid the whole fund, it returned capital to everyone. And we say, look, sometimes you worry about short term things and you forget that before anything, we have a mission, which is to make the world a better place. This alignment of values is fundamental. If you don't have that in your DNA, I mean, it could be like a small shortcut that you take. At the end of the day, that shortcut will harm your business. You might think, oh no, this is just a shortcut that will not generate negative impact. But in the end, you give up and you negotiate and you change the ethics threshold and you don't focus on things which are important, your legacy and certainly assets. Carlos, thank you. Congratulations for talking about pre-investment, investment, and post-investment. That's great. I mean, you maintained your impact status or your impact standing during the three stages. I think I'm going to make the conversation more complex. We're still going down the ABCs. We're still in the A of our ABCs. Before we can talk about, we as the world don't have the language to talk about impact in the same way. I'm going to give you two examples. A company of ours, gender equality, great company. What I'm going to say, look, we're improving our gender equality. We improved it another 20 points. So basically, the first point is the relativeness that exists in all of this. It's all very relative. Second, I would like to take a step sideways, trying to define ESG. All companies can impact in the ESG targets. Any company, even if you sell a toxic product. I don't want to give examples to not offend anyone. Let's say that you sell a product that people inhale and it's bad for their health. You still improve your ESG. And this is an obligation from everyone, and I think it's more standardized. But the second angle of impact is when your core business improves a lot. Then there's impact. Here's an example. Now here we sold a biology company to agro. They're creating basically agrotoxins, and what do? You have bacteria which is spread out through the environment, which doesn't harm the environment. There's a great cost benefit, and the immunological response of the plant is also very good. There are not many businesses where the core business is totally impacted, and our obligation is to challenge ourselves and we want our core business to be more impactful. We have a harsh reality here in Brazil. Let me give you another example. Well, we worked with a company that took about a year. We wanted to provide fish without hormones and antibiotics. I thought people would love it. I asked people, everybody would buy it. We launched it. We did a partnership with a very known brand, and we didn't sell anything. And the price was just a tiny bit higher than a tilapia, than a fish without all these attributes. I mean, perhaps we didn't communicate well, but sometimes the market is not willing to validate these solutions even though you have them. there is a huge challenge still in speaking about impact in an absolute and a relative manner. Two, we have to try to support businesses where there is an impact on the core business, because then your impact overall will be a lot higher. And three, we have to be very careful in calling people out in the process. We have to incent change. We have to provide training and not point the finger, so that companies have the possibility of reconverting themselves. There are a few sectors where I don't see that is not possible. Perhaps I'm not creative enough, but I think most sectors can. But the market has another side. Demand. Are we willing to pay? Zero emissions car. It costs double. Well, no, I can't. The debate of organic food. Organic food is too expensive, so I can't purchase. Many people can't buy it. And the impact is relative, I say once again. While positive change is attainable, even if it's gradual, this will speed up and accelerate things, and then I think in a few years we'll see some benefits. And I think in the future we'll see other requirements, condemning a fund or a fund because it only has one ESG tool, then I don't think that's good. This is our obligation. Well, I improved my ESG. How much? 10%. Not enough. We want more. I think that's the conversation we need to have. Very nice, Sebastian. Carlos, I think there are many messages here for all the other managements. Certainly, due to time, we won't be able to deep dive into everything, but we could have an event just talking about the issues you raised. Well, Gustavo, we're right at the end of our panel, and I left the hardest task to you. You, as an academic, people say, look, well, I'm talking about ESG, and we're talking about impact, but I also know that there is responsible investing. The event is sustainable investment. What do we understand? What can we gain from ESG, impact, sustainable? How do these converge? We see that these things are being incorporated into people's management activities to make this more and more mainstream. How do you see this progress? How do you see all these acronyms and all the frameworks that you're putting in place? What have you done a lot of lately? What have you been doing the most lately? Thank you, Alexei. When the bubble came and the tsunami Sebastian talked about, the work who was in the ecosystem trying to define each one of the terms, everything was basically just flooded by the tsunami, and all the acronyms are jumbled, and we're going to try to reorganize them. But there was a good consequence of the growth that we saw. Historically, in private market, we used to work a lot more on ESG. Just to give you our history, which Bruna has talked about, and the people who placed this agenda forth for private equity and venture capital are the institutional financial institutions, the IDB. Many development banks were cited. These development banks had social environmental policies. At the time, we didn't even say the word ESG or the acronym ESG. It was like ENS, Environmental and Social Risk Management, something like that. And then they would do that, and sometimes they started to work with the private investment market in emerging markets. They became the first shareholders, the LPs of various funds and many managers, and they said you have to implement a policy. And probably Sebastian was the INS officer of this fund that started 15 years ago. And that's at least for 20 years that they've been doing this. And the good part is that these banks used to bring you technical assistance. Many companies gained advisory, free advisory. They paid a tiny piece for that, and there was lots of compliance. There were checklists, etc. Everything, and things progress. This progresses when other investors start to come into the game, a stepstone that not only generate capital from many different diversified investors. Things go a bit more, things became ESG, then it became risk management. We also have to add value. I remember I remember setting up a structure for one of these managers, and according to these templates, for each investment you needed to have a corrective action plan. So you needed a corrective action plan. And we used to say corrective action plan. That means something is wrong if you need a corrective action plan. Oh, but what if there is like an ESG lens that is creating value? I mean, we changed the name from the corrective action plan became ESG value creation plan. We created the process, the deal had to be submitted and validated. But they said, hey, what's the corrective action plan? No, it's the same thing. It's just got another name. It's got a few other things added to it. So at the end, we left corrective action plan to be able to service the template of the multi-fund company. But you have to create value. That's what I want to say. In the business, really, you need to have this impact perspective. We've done advisory implementing ESG in 2 years to now. We decided to create an impact thesis. We also do due diligence, and we are involved in ESG due diligence. We had done 50 due diligences focused on ESG, many of them focused on compliance and risk management. Then 2 years to now, people were asking for the impact due diligence. Help me to build my impact thesis through my due diligence. And what we see in the message that I want to leave for the end is the convergence. It's harder and harder to do one or the other. Once you opt for one, you're going to do a little bit of the other. Our diligences today, and Sebastian perhaps has coined the new acronym SGI. Most of the actions today are SGI investigations. And most of the new funds, if they want to work with ESG, they want an impact lens, even if they don't want to be recognized as or put in the impact category. That is the direction we have taken. And just to finish, I wanted to ask you a question of where we're going in our perspective. It's no longer if, it's when and at what speed now, the rate at which we're going to reach good impact in ESG. We have various frameworks. One of them is the IFC operating principles for impact management, something that the managers and funds can buy into, adhere to, and the fund would need to, or the manager would have to get backing to manage that dashboard. Blue Mark also did 30 ESG investigations, how much the manager was abiding by operating principles. And they basically, of the 30 people that they assessed, those 30 are probably the most advanced ones because they asked to be assessed by an independent assessor, and they've made this assessment public. These are people who are confident. 97% of those 30 that Blue Mark evolved, when they did impact due diligence, only 17% of those 30 are linking economic incentives to ESG metrics, to impact metrics. after the value alignment that Carlos talked about, and that is very important. If you align the economic incentives, then this is the next step, and this is how the segment of the ESG industry needs to evolve. That's all I'm going to say. Thank you for the opportunity. It's been a pleasure. Wonderful, Gustavo. Thank you for your comments. You just had a few minutes to go, but you did very well. We are very happy for the quality of the data. We had very little time, and it was very enriching. And certainly, we could spend, at least for me, I'm very excited to talk about this, and I could talk about it a lot more. But it's very great to have people like Bruna, Sebastian, Carlos, Gustavo, who are in their day to day working on these issues, sharing this with us. It's not like, oh, I'm doing this well, I'm not going to share because I've got a competitor. I mean, we are still setting up the ecosystem, and this is an invitation for everyone to share knowledge so that everyone grows together. After all, we are capitalists, all the stakeholders are important. And this journey will be very important. Thank you. Thank you to our audience. And we hope that everyone is well and that you continue in our event, participating in the event in the next few days. Thank you so much, Alexei, for coordinating this panel. Thank you, panelists Bruna, Carlos, Gustavo, Sebastian. A special thanks to all the speakers of the day, just like our sponsors, MD Reich, and our partners, and you who are here listening to us. We now close with this wonderful conversation, and we'll remind you that the event recordings will be available in the forum platform starting Monday, the 31st of May. The platform is also available until the 4th of June, and we would like to highlight that we do have the networking functionality, and we have over 550 people signed up for the event. So we want you to connect, network. We'll be back on the 27th at 11, São Paulo time. And then we'll talk about the climate, the carbon market, how entrepreneurism has increased social inclusion. And then we'll hear from institutional investors as far as their expectations related to ESG and impact aspects. We count on your participation. Thank you, and see you soon.